I'm Keith McCullough, and welcome back to another Real Conversation. Today I'm with Daniel Alpert, who is a managing partner at Westwood and also a senior fellow at Cornell. Dan, congrats on all that and all that you've accomplished. This is another cycle you indeed get to see. Don't know if you saw it coming, like, from 5,000 miles away or not, but that's it's an interesting conversation to have, obviously, at this time of the cycle, and I wanted to maybe just start with that, like what you think from a top-down perspective, and then we'll get into some topics.
Well, you live long enough, you see everything, right? And I guess this falls into the category of everything. So one of the most interesting things that I think came out at the top of this was that you had a lot of people out there talking about this being some sort of a supply shock. And clearly, this is the world's mother of all demand shocks. It's a complete stoppage of demand across the world. You usually look at these on a regional basis. We've never seen anything quite like it. I would go so far as to say it surpasses World War, because in a World War situation, you have a great deal of procurement of military equipment, and certainly there's no stoppage of consumer demand. Generally speaking, consumer demand isn't being met because of diversion of production. So, here you have a complete cessation of demand almost across the board.
Yeah.
And it's global, and I think that's something that is we've never really experienced.
And this is also common for those of you that don't know. Dan wrote a book called The Age of Oversupply. So, to go from that, obviously that perspective is critical when you start to talk about the demand side of the equation. How do you put them both together? And actually, maybe is that an entree for you to write another book?
Yeah, well, the age of oversupply and incredibly under demand. I mean, the problem right now is that the situation that we had before the COVID-19 pandemic has just been exacerbated, right? We now have, we've lived in a world for the last dozen years, if not more, with an excess of labor, an excess of production capacity, and an excess of capital relative to the demand for all three. And of course, now we've decreased demand, at least for the time being, by an enormous number. And so as a result, we're going to be in worse shape coming out of this in terms of the tsunami of deflation that one typically associates with oversupply. Mm-hmm. The only question is how fast we're going to bounce back out of it.
Yeah. Well, on that, I mean, I'm back and forth. It's almost like it is like Groundhog Day every day here in the office, because I'm basically in here by myself with these guys behind the camera, and I just have conversation after conversation with the people that you're familiar with, institutional investors, and it's just like a back and forth. And when you have the same conversation over and over again, you start to think about new things, or at least that's how my mind works. And one of the themes that I want to bounce it by you is going basically from peak cycle, classic pro-cyclical behavior, like you say, peak labor, peak capital, access to it, the whole nine yards. You go from a theme of just abundance to scarcity. And scarcity, euphemistically or not, just people sitting in, they're at home listening to this, or you're doing it, as well. You're in your apartment in New York. It's scarcity at its core, and I wonder, how you can go from one theme to another so abruptly.
Well, I don't think we're really going to be facing a whole lot of scarcity. I mean, one of the things I'm most worried about right now is what's going to happen when China reopens. Now, by no means do I suggest that the reopening of China is going to be smooth. But, to the extent that they operated, things like their steel plants all through the Lunar New Year before they shut down for the virus, and they're going to ramp up capacity and production again when there's really no export market to be found, they're going to have an enormous amount of inventory when the West reopens. And my biggest concern is that inventory flooding markets. And so if you look at currency imbalances right now, the dollar is screaming again. It's likely to continue to do that. And you're going to be in a situation with, I think the default scenario really is heightened export of deflation from China and other parts of the developing world to the West. That's just going to exacerbate what's been going on for the last decade.
Now, can you go through that? You just linked something that not everybody does, but the dollar to deflation, the credit cycle all together, and where we're at procyclically from that perspective.
Well, obviously the a weaker dollar would create greater propensity for inflation, a stronger dollar for deflation, right? Because you're able to import products cheaper, and your export base is eroded. So you've had a strong dollar scenario now for many years. Obviously, when we entered the so-called trade war with China, which wasn't much of a war, the Chinese quickly allowed the CNY to devalue against the dollar, or basically erasing most of the effects of the tariff. That enabled them to be continuously competitive in terms of their exports. Europe, of course, being in the condition that it is, which is now obviously exacerbated by the COVID crisis, had seen the euro devalue by an enormous amount as post the euro crisis, and that made industrial countries like Germany very, very competitive globally. And so, the strong dollar was a negative for the U.S. economy. It forced the U.S. economy further into depending on service jobs and service functions. The service positions that were created for the past 8 years or so have been overwhelmingly low-wage, low-hour positions. And that put us in a position as this crisis commenced to have tens of millions of very vulnerable jobs in sectors like leisure and hospitality and retail and so forth, that as a percentage of total jobs in America were much higher than they were 15 years ago, and certainly much higher than they were actually at the commencement of the Great Recession. So you have this dollar situation that translates into the employment situation, that translates into credit, which is obviously based on the overall balance of capital in the world. That produces a very, very difficult environment for us right now, and requires the kind of extraordinary policy interventions that we're seeing.
Yeah, and I want to come back to that and on the unemployment side, because that's where obviously you have plenty of expertise. But just to finish on that Chinese piece and tying that, their U.S. dollar denominated debt, their developing deficit, guys. If you go to slide 122, just so that people know what Dan already knows, where the trade weighted dollar just broke out to basically a 25-year high. And then on the right side, we show what Chinese reserves have done of this chart. I don't think you can see the charts, but I'm sure that these are emblazoned in your mind, Dan. But again, this moment of a strong dollar where the Chinese are beholden to it, so to speak. And then on slide 123, guys, you can show that deficit developing. And then just the reality that these Chinese reserve requirement cuts, really haven't had that stimulative impact that they had and created all these oversupplies when the Fed was devaluing the dollar was weakening both in 2016 and back obviously in 2011. Again, is that something that you think the world, at least the people that you talk to, fully understand how hamstrung the Chinese are by a pervasively strong dollar, no matter what the Fed does?
Actually, they're benefited by a strong dollar, not hamstrung by it. I hate to differ with you, but obviously they are an export economy. They're trying to maximize the market for their products. They're an economy that's driven predominantly by employment, right? They need to add 10 to 12 million new jobs a year in order to keep their population happy. And in order to do that, they have to depend on two things: state-financed infrastructure for the most part, and their export economy. And so in order to continue that export economy, they need a fairly weak currency and a fairly strong dollar. And they need to be able to make their exports attractive to the rest of the world, which is what they've been doing. What the Chinese do domestically in order to spur the infrastructure economy is sort of not very important globally, simply because the Chinese currency is neither freely exchangeable nor freely convertible. Every dollar that we send to China to pay for goods that we import passes through a unit of the People's Bank of China, known as SAFE. They receive the dollars and they pay out RMB or yuan to the vendors. So that enables China to build up these massive foreign currency reserves in dollars and euro and yen without having to endure any pressure on their currency, which would be the result of what would happen in most places, where if we were buying a product from the UK, we would pay in sterling. We would buy sterling, and that obviously would increase the value of the sterling. So what China has done is sterilized its currency, created a sort of an internal script that 1.4 billion people use, which is not a small number, and enables them to run their economy as they see fit. Not a really good deal for the West, and has created the kind of dislocations that we've seen for the last 15, 20 years.
Yeah, I didn't mean in terms of quibbling on the realities associated with their export demand. Obviously, that's why they're they're doing that. But if you another slide, guys, if you pop that up there on slide 121, what I was showing is the dynamics between periods of dollar strength and the inverse relationship to secondary industry growth in China, which is where they've created epic levels of capacity. I mean, as you know, that was like 50% of GDP growth in China coming out of 2016 when they stimulated like they'd never had before. And again, that was during a weakening of the US dollar. So our argument is that the weakening dollar allows them to stimulate more aggressively. So I'm just talking about the PBOC's actions. This morning, in fact, the PBOC basically said what I thought that they'd say in that regard, which is the PBOC basically said, hey, look, I know the Fed's going to QE infinity, but we're not really willing to do that at this juncture.
Yeah. Well, I'll just go one step further. Obviously, with a weakening dollar, they're kind of forced to depend more on the infrastructure side of their economy, right? The domestic side of the economy. So the cause and effect issue, we can quibble over, chicken and egg, which comes first. But at the end of the day, their reactions have been over and over to try to tolerate a stronger domestic currency, their currency. And every time they've tried to do that, they've sort of ended up on the short end of the stick, meaning their economy slows and they get very nervous and they go the other way. But there's a lot of misconceptions about the way China works. People in the West tend to look at the enormous amount of bad debt. There certainly is an enormous amount of bad debt, but you got to remember the state is on both sides of this equation. Not only does the state still control, either directly or indirectly, a good deal of production in China, but the banking system, again, directly or indirectly, is completely controlled by the state. And so taking bad loans off of bank balance sheets and recapitalizing them with this currency that is neither freely exchangeable or convertible is not a big deal. And they can do this ad infinitum, and they have been. Mm-hmm. And I think they're going to continue to do that.
Do you think, longer term, some of us talk quite a bit about a Chinese moment being a Japanese one. Do you think that the secular high for China was in 2007, 2008?
Well, it's hard to say. I mean, it depends on what statistic you're looking at. If you're looking at growth rate, yeah, probably you get, there's no question if a country's starting from nothing and they're trying to build, they're going to have an enormously high growth rate. But China has got a bench of labor that you could say sort of Japan kind of had, but not really. And that is you still have non-urbanized population in China of around just under 600 million people. Those 600 million people are not at all tapped into the global economy. They're for the most part, on the farm, so to speak. And China is very, very concerned about not urbanizing them too quickly. All of the pressure that is on them to restrict immigration into urban environments, the permits and all the other things which people routinely violate, it creates enormous social pressures. They can't find jobs for these people in these urban environments fast enough. So what they're trying to do is regulate the urbanization of this enormous bench strength that exists within their economy. So they can continue to do that for a very, very long period of time without suffering any inflation, because you just, obviously, to the extent inflation crops up, you just tap into a little bit more of this low wage labor that exists indigenously. So it's not, China's never going to be in a situation where they're going to hit, some massive Japanese style collapse. That's just the two situations could not be more different. But the situation from the West's standpoint is incredibly ominous, because you've got this economy that can just continue to add from its infinite resource of labor and continue to build infrastructure and capacity with that labor and with the script that it issues domestically, without concerns about runaway inflation or any other ill effects. You translate that out of China and you start looking to some of the other post-socialist countries, and especially when you consider the fact that, God forbid, from an American perspective at least, if India ever got its act together and started to emulate China in the same way, you'd be facing a wall of non-urbanized labor that would last 100 years in terms of its ability to be integrated.
Yeah, can we pivot to that U.S. side of the problem? You mentioned you said tens of millions of jobs, and that's in the area code of where we're at. We obviously don't know how many are going to be unemployed, but I mean, you started with the point that these are very low-paying jobs on a historical basis if you look back anyway. But can you flesh that out in terms of this moment? I mean, these numbers, Dan, as you know, like for bean counters like you and I, like these jobless claims number, unemployment numbers, they're things that are completely off the page in terms of any historical context.
Yeah, I mean, we're losing jobs at an incredible clip because we shut down the economy. We put the economy into what I call the equivalent of a medically induced coma.
Right.
Right. We're in a situation where we basically said, let's knock everybody out and fix the disease, and then we'll revive everybody when it's all over. The number of jobs that I think are vulnerable in the first wave, and it's important to understand that this is not all going to happen at the same time. The first wave of jobs that's vulnerable are these customer-facing service jobs, and those jobs are in the obvious sectors. You've got 14.5 million people in production, non-supervisory jobs, and leisure and hospitality sector alone. That's an enormous increase over where we were at the beginning of the Great Recession, even on a per capita basis. And then you've got obviously the retail sector, and you've got other service sectors that simply have no purpose today with the economy shut down. So we count with our job quality index, and if you're interested, you can find this information at jobqualityindex.com. We count about 37 million jobs that are vulnerable across the country to this first wave. Now, do I expect 37 million jobs to be lost? No. First of all, it's not going to peak everywhere, and as you know, we still have states that haven't even locked down yet. So, when you go into that, I would expect of those somewhere between 15 and 17, and I hope I'm right, because anything more than that would be pretty horrible. That's horrible enough. Of those jobs will find themselves terminated, at least for the short term. So then you have the next problem, which is what happens when, it's one thing for the auto salesman in the showroom not to have any customers because no one can show up. It's another thing for the auto dealer to get on the phone, call Detroit or call wherever the auto plant is and say, listen, those cars that you were going to send me for the next 4 months, well, don't send me any. I've got too many on my lot. I can't possibly clear them. So you better shut down your factory. Well, now, and obviously we do have factory shutdowns already, but I'm using that as an example. You take that to its extreme, and you then have a big hit to what's left of our goods producing economy, and that creates yet another wave of shutdowns. And those jobs are not included within that 37 million because they're, generally speaking, are higher wage and higher hour jobs. But we've become incredibly dependent on these low-wage, low-hour jobs in this economy. We thought we were at full employment. What we were at, actually, if you look at the hours worked, and keep in mind, I just to illustrate this for your listeners and viewers, the average job in the leisure and hospitality sector produces 26 hours of work a week. Mm-hmm. Well, it doesn't take a lot of math to figure out that an average wage of 15 or so dollars an hour times 26 hours, it's not a lot of money. And that's 14 million people, right? So you're talking about just an enormous number of people who are on the front lines, whose jobs are being terminated as we watch, and who are not in good jobs to begin with. This is, by the way, one of the issues that came up in Congress, where everybody was looking at that $600 stipend that was going to be added to state unemployment benefits. And some of the folks in the Republican Party stood up and said, well, heck, these people are going to be making more money than they were before they lost their jobs. And the answer is, you're damn right they will be. And, yep. and the obviously these benefits will be time limited, so they're not going to cause them to stay out of work forever. But it's very important that this money flows.
Yeah. I mean, I laughed not because it's funny. I laughed because where I'm from in Canada, we call it pogie. Like, I'm from a small town in northern Ontario, and look, to get paid pogie, and if it's fishing or hunting season, you might take that because there's more money in that than actually having a job on the service side of the economy. So I think that's an interesting, cultural fabric that comes into play with these bailout dollars. We'll get to that maybe a little later on, but I just want to flesh out these bigger numbers that you have because you're very specific on them. You're one of the world's best at them. So you go 14 million in this service component of the economy. We've got 15 to 17 million is your estimate. 37 million is the vulnerable. So between the 17 million and the 37 million, how much of that is the second wave or the knock-on effect of what will be a sharp depression, then a recession, and how long it takes to work out of that?
So just to clarify again, so the 37 was just the frontline jobs.
Right.
And the only reason that I'm limiting it to 15 to 17 million is I don't think every state will shut down.
Okay.
In New York, for example, while countries in the heartland will be going through the worst of this. So, it won't reach a peak of 37 million. It'll be something below that. And also, not every job in these sectors is going to be lost. There's still going to be need for food service, delivery service, things like that, even though the full service restaurant might be shut down. So, that's, I think, something to think about.
Yep.
But that 37 million that I articulated doesn't include any of the goods producing side of the economy.
Okay.
And so to the extent that we lose 15 to 17 million in the frontline customer facing service side of the economy, and then that rolls over into the goods producing side of the economy, you're talking about a much higher number.
Yeah.
And I haven't actually figured out what's likely to be lost on the goods producing side. I'm just hoping we don't get there.
Well, that's literally, like I say, I go back to the Groundhog Day and all these discussions I have with different kinds of institutional investors. Most of them have come to the realization that we're not going to have a V-shaped recovery just because we went into the bad side of the V on the demand shock side. A lot of them are talking about the workout period. And I think that's really the scary thing, is that a lot of businesses don't make money, to use the analogy. If you can't get a hotel back up to even 75% occupancy or a casino up to 85%, they're not going to gainfully employ anybody because the place doesn't make any money. And the same could be said, analog, obviously you mentioned restaurants. Have you thought about that? Like, how long, and is there any possible way for us, in my case, this numb-headed human, to come up with a calculation on that when it's a nonlinear reality that has behavioral factors?
Well, I think the last words you just said, behavioral factors, are the most important. The best example of this that I heard recently is, obviously we're going to experience something akin to the Nike swoosh, right?
Yeah.
It's
Actually, I heard that in two calls yesterday. That must be going around.
Right. But okay. So the Nike swoosh. The question is, how swooshy will the swoosh be, right? So the angle of the swoosh is really important here. And that, I think, is going to be determined to a large extent by the fear factor.
Yep.
There's a couple of things that I like to talk about. Now, I'm not a medical expert by any means, but I think I understand the basic reality of what we're facing. Right now we need to find out who's sick. We need to treat them. So testing has been very important. But in the nearer term or medium term, testing is going to be less important. We're going to need to find out who's been exposed. We're going to need to develop dependable antibody tests. There's a group up at Mayo Clinic that is working really hard on this. They're by no means the only group. There were a couple of tests that were rushed out in Europe, didn't work too well. But I think among all the scientists worldwide who are working on reliable antibody tests, you're going to get something relatively soon. That's not a vaccine timeline. That's a multi-week timeline. So, being able to know, for example, did the fever that I had for 48 hours, didn't get even to 100 degrees, but did that fever constitute my experience with this disease? I have no idea. I hope the answer is yes, because I'd love to have some antibodies. But there are a lot of people who are asymptomatic, who have mild symptoms. We don't know what they've got in terms of immunity. Those people are going to be very, very worried about showing up at your casinos or your restaurants or anywhere else. It will really create significant problems in restarting the economy, because that fear factor is going to be quite prevalent. I don't envision a picture of people standing around the craps table with surgical masks on. I just think they just won't show up, and so I find it very difficult to believe that until we have some way of giving people confidence that it's okay to go back out with a reasonable blood test, that we're going to be able to restart this engine that quickly.
So, I think most people will agree that the behavioral side of this is just right gnarly. But if you just take the vector of history's lessons on what constitutes an actual depression in economic growth, guys, on slide 34, Dan knows this, of course, too. But just the duration and the severity is something that I often get in. I first start to get in arguments when people start getting their ass kicked by the stock market. In the first month of the decline, that was more the debate. And then in the second month, there's more of this, okay, maybe this is real. But quite literally, as you know, you have not had what I'd constitute a depression, which is something greater than a recession, going all the way back to the 1930s. And the workout periods there were many, 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 many months. Trump couldn't use another many to characterize how many more months you might have versus what he personally might hope for. With the election coming. It wasn't meant to be kind of a poke at that, but I'm sure that you'll have some thoughts on that too. What is it about an economic depression that mathematically makes the workout period just a long time?
Well, the thing that is the main feature of an economic depression is obviously the thing that we're seeing today, a complete collapse in demand. Right. And so the thing that gave rise to the collapse in demand in the 1920s was very similar to that which happened at the time of the Great Recession. The only difference was how we confronted it. There was no, 3-year-long period, and the second part of or 2-year-long period, the second part of the Hoover administration, where they did, pretty much everything they could do wrong, and then, the need for FDR to show up and restart the engine by shutting it down at first. And then starting square one. That didn't happen in the Great Recession. We learned enough from the Depression to institute better policies. Some of those policies were, in my opinion, nowhere near enough. In this case, we now have the lessons from both the Great Recession and the Great Depression.
Right.
And what that has done is it's gotten people's eyes wide open. To look at what needs to be done in terms of making sure that this situation does not result in a true economic depression. Sure, we're going to see GDP in the second quarter fall by some hellacious number, and that's simply because nobody's out there spending. We're also going to see people, to the extent they are still employed, and even to the extent some of them receive government funding, build up some savings, which is going to have an interesting effect after the fact.
Yep.
So the key is what the response is, as opposed to what traditional depression economics was back in the 1930s. We're not going to see, I hope, a protracted period where no one can find employment and nobody has any money. What the government has done, which I find extraordinary, because we have basically established a completely new paradigm for the covenant between government and the people relative to the last 40 years. And we're about to see whether this experiment plays out in a way that's going to effectively change the way we look at the economy going forward.
Mm-hmm. Well, I mean, you go back to TARP. I mean, I remember, back then I didn't have gray hair. Now this cycle my hair is gray. Next cycle will be gone. I mean, it's just people were quite literally pulling out their hair just to get to where we got to, or by October of '08. It, of course, still didn't work for the market. But to have that all happen in such a short period of time, I mean, it's amazing. I mean, I think, like you said, it's unprecedented. What do you think on that? Like, I mean, is that enough? If 15 to 17 million people, by my math, just on a napkin, I could tell you that it's not. If that's what you need to stopgap.
I mean, is what the government has done thus far enough? I think the answer is no in the short term. But the type of intervention that has been undertaken in the CARES Act is exactly what was needed, and of course it's expandable. As you know, McConnell went back and is drafting a bill to expand the PPP to by another $250 billion. There's going to be plenty of money available, and there doesn't seem to be any reason to cease the amount of money that's available, or to limit the amount of money that's available. The biggest issue here is understanding what's really going on, and that is that we are monetizing. We issue the currency that we print. And it's ours to issue, and to the extent that we want to issue it and hand it to households as opposed to use it to bail out banks, we're going to be a lot closer to fixing the situation than we were when we expected all that money to somehow trickle down through the banking system and out the door to borrowers who really weren't there at the time during the Great Recession. Mm-hmm. So this is a far more immediate, hands-on remedy than's been attempted before, I would argue, in terms of the short-term part of it, it's more aggressive than even the New Deal. Mm-hmm. Not necessarily in terms of job creation by the state, which, if you listen to the president, is next on his agenda. I don't know if he's going to get to it. He's talked about it many times before. But to the extent that we move to a situation where government has a greater role in the production of public goods than it has over the last 40 years, because no one is worried about government deficits, which they shouldn't be worried about. This could produce a real silver lining for Americans and for the economy and for the markets.
Well, on that, on the deficit, so I'll just show a picture so people have a frame of context. I always think for any time we're having a macro discussion, please have the time series that's available of the statistic that we're talking about, in this case, the deficit, slide 90, guys. What I'm showing on this slide, Dan, is the unemployment rate against the deficit, the growth rates of both. What you find, obviously, is once you enter a recession, they both hook upward together and they hug each other, and it's not all that much fun. But to your point, I mean, we're already, whether you like it or not, the deficit as a percentage of GDP is going to eclipse pretty much everything other than '08. And what is the capacity for that? And where do you think that this actually, I've heard a lot of different opinions on this number. Where do you think the unemployment rate could go to, and where do you think the deficit as a percentage of GDP could go to?
Well, of course, the deficit increased over the last few years before this crisis because of the tax cuts, not because of policies such as the ones we're seeing right now. The deficit increase, is really you need to look at the deficit the way I think most people are starting to understand it. When you run a deficit at the government level, you're putting money into the economy. You're putting money into the private sector. It doesn't cost the government anything to actually create that money. It's a keystroke at the Fed. The question is then whether or not you issue treasury bonds to fund it or whether you tax to pay it down. Obviously, there's not going to be any increase in taxes for the foreseeable future, and I mean a long time. So, the real question is how do we, to the extent that we don't want to purely monetize, how much incremental treasury bonds that are not owned by the Fed are going to find their way into the market. My argument is none. Effectively, the Fed is going to continue to buy an amount in the secondary market equal to whatever the Treasury produces, with primary dealers. Effectively, if you just lifted the curtain and looked at this on a consolidated basis, the Fed is basically buying all the new issuance. And what is the capacity to do that? The capacity is infinite.
Yeah.
From an operational standpoint, it's infinite. The only restriction is inflation, right? At what point do you create so many dollars in household pockets that they run out chasing the classic definition of inflation, which is too much money chasing too few goods? Well, we have no shortage of goods in this global economy. One of the problems is that we need to start looking at inflation on a global level, meaning you can't just look at goods production in the U.S. the way they did 40 years ago, and look at demand in the U.S. and say, okay, well, if we have more demand than we have supply, we're going to get inflation. That's what we saw in the 1970s. But today, as I started at the very beginning of this conversation, the amount of potential production is not only far exceeding demand, it's growing. Mm-hmm. And so we can continue to pivot to the production of public goods. I'm not a big fan of universal basic income at all. I like to get some bang for my buck. If we're going to pay people, let's build something, right?
Yeah.
So we can rebuild our bridges and our airports and do anything the hell we want until we literally see the whites of inflation's eyes. That's the key, and that's the way we should be running our economy. That's the way we should have been running our economy for the last 10 years. Now that you have two things that have fallen into place, you've had a Republican president who has created an enormous deficit by virtue of tax cuts that favored the better off, and now you have this horrible crisis that's going to lift that deficit by trillions of dollars. You've now got people who are going to receive that money far more directly than tax cuts to the rich, and you're going to see the benefit of that money floating into the economy far more directly. That is going to create a very interesting picture, and certainly a rebuke to those people who favored austerity in the past. We can continue to do that for some time, and I mean, probably a decade, I guess, to improve the lot of our society, and I hope that we do that.
Well, the interesting part, you made this point, is that whether you're of the ultra-conservative ilk or of the austere community, it doesn't matter what you think. This is what's happening. So again, that's the space I deal with. You'll find that I don't have an opinion really on people's opinion on what it should or could or would be. I'm dealing with what is, and what just happened is. So, with that in mind, I wonder if you have an opinion on this in terms of, and tie it maybe if you can to the election. You have the likes of Stephanie Kelton out there at Stony Brook. I think most people listening to this know who she is. If you don't, you should look it up. And essentially what I think is a modern, at least the initial version of MMT going on anyway. And then you have two presidential candidates. She's of course, I think she's still Bernie's advisor. I'm not sure. It doesn't matter if she is or not. But you have that.
Not this time.
Not this time around. But you have that view, and then you have Trump. And to me, at least to me, Trump would be wide open the way he's behaving right now. It sounds like he would quite like the idea of MMT as well.
Well, I think that, Trump as a populist was very attractive, and obviously as a real estate guy, his attitude is more leverage, the better. And if you can borrow cheap, borrow money.
Yep.
So while his understanding of this is not equivalent to Stephanie's understanding, He does understand the basic fact that if there's too much capital floating around in the world and that capital is not being put to productive use and merely being hoarded, because when people talk about China owning treasury securities, and yeah, they own a bunch of treasury securities, but they own that's their version of the mattress, right? They're sticking, they have to put it somewhere. They might as well make a few bucks on it if they can. But their primary purpose in owning those in holding those dollars to begin with, is to not convert them into RMB, to sterilize those dollars and prevent them from increasing the value of their domestic currency. And so they're going to hold them. And of course, they're going to invest them in treasuries. That's the only place to efficiently store them when you have sizable amounts. I mean, you can't just go and to the extent that they don't buy a treasury bill, they keep them in an account at the Fed. So it's one way or the other. But the issue is the huge amount of stranded money that's not being put to productive use because there's no private sector opportunities to increase capital spending in a way that creates jobs and growth. That money is it really ought to be tapped by the one entity that can borrow it cheap, which is the entity that owns the printing press with which to pay it back. Right? I mean, there's zero risk of the U.S. being able to repay its bonds. It just presses that key on the computer, and the bonds are repaid.
Control Alt Print. Yeah, I guess we're all going to get a piece of that. But we applied for the SBA thing. Anybody who's got a brain should have done that. But where do you think it ends up on the election? Like, do you think that the Kelton view would just be a bipartisan view that both parties would support?
Well, I don't think we're going to, I wrote a column for Business Insider last week, or maybe it was the week before, called "We're All Modern Monetarists Now," right? It was a takeoff on Milton Friedman's "We're All Keynesians Now." But, it's true. At the end of the day, I think everybody's waking up to the notion that a country that issues a currency in which it borrows exclusively can borrow as much as it wants, or actually doesn't even need to borrow at all. In theory, it could just monetize its spending. Actually just print the dollars and spend. I know that's not legal, but as an economic matter, it's totally doable. So that is one of the things that's coming out of this to the tune of trillions of dollars, and it's never been done before. It's obviously needed. Thank God everyone got their act together quickly. It's really quite remarkable. Just as an aside, there's a lot of bitching and moaning about how long it took Congress to get that bill through, but and I hate to think that it takes a plague to get Congress to legislate, but it worked, and people actually got it, and there were a couple of wackadoodles off on the side who were saying, "No, we can't do this, we can't do this." They were crushed by the leadership in the Republican Party. So. This is a huge issue, and it's one that's going to reverberate through the economy and through politics going forward. Let me put it this way: if Donald Trump thinks that this economy needs a shot in the arm in order to get him reelected, you're not going to hear a lot of people pushing back on a major infrastructure bill. The biggest question when you go up on the Hill, and I've done it many, many times, is, okay, this is great. I see the economic benefit of infrastructure spending. I see the economic benefit of borrowing. And by the way, when I was making those arguments, the 10-year rate was at 3%. Today it's at 75 basis points. I understand the benefit of borrowing cheap and how we can make a lot of money by borrowing cheap and reinvesting it, rebuilding our country, putting people in higher wage jobs, having them spend money, procuring our steel domestically instead of from China, all the things that we can control if we do public goods, as opposed to the private sector who just wants to buy everything as cheap as possible. Everybody says, I see those benefits, and then the conversation ends with, but how are we going to pay it back? Yeah. And when I turn to them and I say, why are you worried about that? I can walk you down the block to the Mint and show you how you're going to pay it back. You're just going to print the money and you're going to pay it back. And people will start talking about the 1970s and debasement of the currency. And it's like you're in the Middle Ages. when you have conversations like that. You know, the word debasement came out of people actually clipping pieces of gold off the currency, right? You know, this is nonsense. And you know, the one thing that has disproven all of these concerns is the screaming dollar itself. You know, the dollar has been on a tear throughout the post-recession period in a way that flies in the face of all of the deficit worries and all the other concerns. The one thing I just want to point out to you, Keith, you'll remember this because do you remember right at the beginning of the global financial crisis, oil spiked. Remember, it spiked to like $150 a barrel, and it was all option contract trading. Mm-hmm. What was going on at the time is everybody assumed that the dollar was going to devalue massively because of the government intervention and all of this money printing, and so people started using. When I say people, including the Chinese and other people who were formerly holders of U.S. Treasury debt. You know, they started to rotate into oil contracts as an alternative storage place for dollars.
Right.
That caused this massive spike. Mm-hmm. Well, just the opposite is happening right now. Think about that.
Yeah.
There is no other place to go except greenbacks. And what you saw 20 days ago now, I guess it was, when the Treasury rate spiked. I forget how many days are we into that.
It was like
what
3
days?
weeks ago.
Anyway, but
right,
2 weeks ago, right? That was a grab for greenbacks. That was you know, literally people wanted to be not in marketable securities, not in treasuries. They wanted cash.
Yeah, they wanted dollars. They were getting
they wanted dollars. They were getting margin called. They wanted liquidity. They wanted all sorts of things. You know, the dollar is king right now, and it's going to continue being that for a long time.
Yeah, I agree with that 100%. I mean, our biggest positions are long dollars, long treasuries, and gold would probably be in third next to my wine. I guess I got to have a liquid asset that I can consume as well. But the, you know, on the deficit myth, I think that's actually the name of Kelton's book. I mean, you know, that's really a thing that's no longer a myth. It is happening. So I encourage people to not, you know, be viscerally impacted by, you know, some of the things that Dan said. That's exactly what's going on. There's really now your task is to understand it. It's not to really fight it. I don't know how you could fight against it actually happening. When people tell me I can't fight the Fed, Dan, I kind of giggle. I'm like, well, I buy what the Fed buys every friggin' day that they're down, which are treasuries. Right. So what is kind of interesting is that the dollar does provide, you know, kind of an anti-gravitational device. Like people that do believe that the Fed doing what you just said. And maybe that's my last question before I take questions. If you guys have questions, please pop them in the queue. People vote on your questions, so if it's a good question, I'll ask it. But you know, that's a question that I get all the time. Like, how can you say that, Dan? You know, that they just hit the button and they're just going to keep hitting the button, and that the dollar can't go down? Like, people are apoplectic about that.
All right. Well, so it all comes down to transmission, right? You need the dollar to actually create spending, right? Right now, let's face it, you can't spend. There's nothing to spend it on. So, just under
exactly.
the current crisis, right? Under the current crisis scenario, let me put it this way: Amazon couldn't deliver enough to move the needle, right? So there's nothing to spend money on right now. So that's not going to have any effect. But after we come out of this, could you see some minor dislocations in prices? Yeah, sure. You know, you could see a momentary inflationary blip in one particular asset. You know, people are thinking, well, maybe food, but I don't think food's going to be the thing since everyone's continuing to eat during the crisis. But you know, there may be one or two things that you see a couple of little spikes with because there's been so much money pushed in the economy. But again, you have to look at that relative to available supply, and available supply is not just domestic; it's global.
Yeah.
And one of the problems with monetary policy as opposed to fiscal policy is so much of it leaks abroad, right? You create increased demand by dropping mortgage rates because you reduce reduce interest rates rather, and that money, you know, consumer goes out, as lower mortgage payment, is more money available to spend. He goes out and spends, but a lot of that spending finds its way to China, for example. So, you know, that's what I call leakage from monetary policy. Well, you're going to have the same thing here. There's no difference with the transmission mechanism. You're still putting money in people's pockets. And so, the idea that somehow this time we're going to see this, sort of 1970s effect. And, look, in the 1970s, we legitimately had 30 years of wealth creation that had made American households very wealthy, had a really high savings rate, and people wanted stuff. And we weren't manufacturing stuff at a rapid enough clip and on an efficient enough basis to satisfy that demand. That produced frontline inflation. The inflation wasn't all that bad because, it was bad, but it was only 18 months ahead of wage inflation. So the pain that people felt for all those years was that wages weren't rising fast enough to keep up with the price rise. When Volcker stopped prices from rising, wages caught up, and we were off to the Reagan expansion. But that was a real effect. There's zero chance of your experiencing that today, not with this enormous oversupply that comes out of the rest of the globe. So yeah, sure, you could build a wall around the borders of the U.S. economy and you'd have massive inflation, but that's just not going to happen.
That's a good explanation. All right, this first question.
And I should finish by saying, without inflation, you can't tank the dollar, right? That's the necessary feature.
Absolutely. All right, this first question, and this one's, I like that this question has a lot of votes, guys and gals, because, when people ask about the market, like I really don't know what you're asking. I know what I think about the market. So the question is, when does the market understand all that you think is going on here, Dan? And the market, to me, like if we're talking about the market, the Treasury bond market's got this. The dollar's figured it out. Commodities have figured it out. It's the stock market, I think, that the question's most likely implying. You can talk about the market broadly or the U.S. equity market specifically, but I think that when the question has to do with what's going on, like your view of unemployment, your view of consumption, your view of the actual recession or depression that we're in.
Well, two things. I think number one, the stock market obviously declined to a panic level for a period of time. And I'm not saying that bottom is not going to be tested in the future. There could be other things that give rise to panics. But, the bounce back from that panic level is, something that to be expected now that we have our arms around the dimensions of this crisis. Right now, the equity markets are trading on events. They're trading on number of cases. They're trading on flattening the curve. They're trading on expectations for new tests and vaccines and what have you. These are all event-driven things in equities. As I think you and I were both taught at an early age. Bonds are bought, equities are sold. Somebody needs to be willing to take risk. People need to invest in bonds because they institutions need the income and they have roll off every day. So, there's always demand for both treasury bonds and higher yielding bonds, meaning investment grade corporates and, even to a certain extent, junk. But, equities are something that somebody has to wake up in the morning and actually want to buy, either on a speculative basis or on a value basis. Relative to the last 5 years of history, it would look like there's some value in the market. And so to have people reach consensus, as they apparently reached over the last several days, that, it might be time to take advantage of some of that value if the market's stabilizing, is not surprising, and that should go on. Are we going to get back to the sky-high values that we were in February? No, of course not. And probably not for a very long time until the next cycle. But you're right. As usual, the bond market got it right. The commodities market is unduly affected by the Saudi-Russia bickering, which had an enormous impact on oil prices. I think when I ran the numbers and figured out that on an inflation-adjusted basis, oil is cheaper now than it was the 1960s when I was a kid, that was fairly startling. So this situation may stabilize. I'm not saying oil is going to start going back up to higher prices because, let's face it, long term, it's a dirty fossil fuel, and there are going to be other things that are going to start to replace it. Albeit that will slow down because oil's so cheap. But the equity markets are something that there'll be clear profit taking. Yesterday we saw that in the afternoon. I don't know how the market's going to close today. I'm not looking at my screen right now. I'm looking at you. But I don't think that the direction of the equity market is going to be such that you want to count on anything looking anywhere near like a V, even a U, you're probably down to reasonable recoveries to multiples that make sense, with the understanding that a good chunk of the S&P 500 is going to have massively depressed earnings for a very long period of time.
Yeah, that's the part that in '01 posted another shock, 9/11, that people just couldn't quite get their arms around, is the deleveraging of corporate balance sheets and the deleveraging of earnings. I mean, that was really the recession. You could barely see it, as you know, in '01. It was negative 0.3%, but the stock market didn't bottom for a year after the economy hit its rate of change bottom. Second question, this one, I've actually never asked this one on Hedgeye TV, but I want to know Dan Alpert's answer to this question. Given Dan's economic and policy outlook, what one investment would he put his grandmother in today?
I thought you were going to ask boxers or briefs. Anyway, my grandmother, I wouldn't. My grandmother would be firmly in CDs and dollars.
Yeah.
The answer is you don't screw around with people who need their money in this market. This is not a growth environment for people who need their cash. The biggest concern, obviously, is where do you go for dependable yield that is not Treasury level and not bank CD level. The where you should be tiptoeing around at this moment is looking at preferred dividends. I mean, let's face it. Common dividends are going to be under some pressure. Preferred dividends less so. There's nothing sexy about buying preferreds or preferred stock funds. But if you want to produce a little bit more income, the value of these funds have fallen. The value of some of the preferreds have fallen, just on a not on an entirely a rational basis, but just on a reaction basis. To the extent that you're trying to increase income a little bit, that's probably the only way to go right now. I wouldn't be messing around in pure credit, meaning junk. Because those bonds are selling cheap for a reason.
Yeah, I mean, people. You talk about like something that's boring. I mean, people don't quite get that. The U.S. dollar is up almost 4% this year. I mean, relative to the alternative. I mean, gold's had a pretty good move too. Treasuries have been fantastic, but I mean, it's not like it's nothing. Being in cash, I think people screw that up. Like they don't actually buy the currency. They don't quite get that.
I'll extend that just a little bit if you don't mind. There's got to be a connection in investors' minds between inflation and investment decisions. You should take risk in an environment where inflation threatens to erode purchasing power. Inflation at zero or deflation. Deflation is a situation where if you put your money on the table, its purchasing power increases.
Yes.
You don't have to do anything with it, right? So that's your return right there. And the notion of taking meaningful risk in a disinflationary or deflationary environment to me is ludicrous. It always has been.
Yeah.
The human psyche is such that people look at nominal yields or nominal returns and they say, well, geez, it's too low. I can't stomach this. And they don't really focus on the issue of purchasing power. Look, you can be making 10% in an environment where inflation is 10% and your real yield is zero.
Yeah.
Right? So it's all relative.
I think it's just emblazoned into people's poor skulls that they're watching what I affectionately call old wall TV, and all they do is talk about stocks, and that's what it is.
Right.
But maybe last question here, and this is really tied into that. Given your a lot of different kinds of ways people have asked this question, which is given your, and you've been as consistent as anybody, I think. Gary Schilling maybe would be right there with you, but consistent on.
Gary's got me beat.
Yeah, I think it's just because he's got like a decade on you, maybe. But it's just
Yeah.
you're a young man. Gary's still sending me his honey. I love that stuff. I don't know if you're on that distribution, but that stuff's awesome. That guy's great. But the question, because you guys you've just been right. I mean, I don't know how else you could say it. I mean, it's just been right on deflation is a much bigger risk than inflation. Being long treasuries, has certainly been one hell of a long-term hold. But the question has to do with what do you think the 30-year does, and could we have a 50-year, and how people want to get into the more and more and more. Do you believe that can happen? 100-year bonds, COVID bonds. They're talking about stuff like that.
I've been a champion of increasing the tenor of bonds for a long time. I think there's an appetite for it in the market. Treasury goes in and they say, they talk to the primary dealers and they say, how much demand do you think there'd be for a 50 or a 75 or a 100-year bond? And what are the dealers likely to say? They're not likely to say, yeah, sure, give us some of that paper so I lose demand for the 30-year securities I'm already holding. Right? Right? So no one's going to say yes to that question. You actually have to do it. And there's other forms of issuance that should be considered. Back in the 19th century, not to play historians, but the UK issued something called consols, which are effectively annuities. They were callable securities where they said, listen, I will pay you at that time 3% every year, and it's perpetual. I don't ever have to pay you back, but I can call you at any time. There were some call windows actually, but yeah. That is also something that should be considered, which really does bring you down to the issue of whether or not government, sort of like the Japan postal system or any other comparable systems around the world, should provide what my writing partner Bob Hockett sometimes calls people's savings accounts. Effectively allowing people to we already have them, by the way. I don't know. Do you personally use Treasury Direct at all? I do. It's a wonderful service. Anyone can go online, open a Treasury Direct account, and you can buy Treasury securities on your own, no premium, no nothing. And you can bid in the auctions just like the primary dealers can.
Yeah, it's cool.
Except for limited amounts. So. That is something that any investor should be considering in terms of stashing away large amounts of money.
Yeah, I think people are getting educated, on the topic. Again, I think it's kind of sad and pathetic that people didn't know that there was something other than stocks to invest in. But obviously, the returns associated with being on the right side of the bond market speak for themselves. But again, I just wanted to, our time's up here, Dan, but I wanted to thank you. And encourage people, by the way, if you haven't read The Age of Oversupply, not a lot of economic long-term forecasts, if you will, or frameworks age well. And I think you wrote that in 2013, maybe, Dan? So that was a while back. Great. I mean, it's not a call. It's just a framework by which you thought it through. And then, and of course, the Job Quality Index. You've done a lot, for people out there. And I think that, people should check that out and stay current with your views because you're very additive to helping them educate themselves, which is probably I always say that's probably the most important core holding you should have during times like these. So thanks for that.
Well, thank you. And I hope everyone out there stays well and healthy and protects themselves and doesn't do anything stupid. Let's stay inside and keep each other from getting sick.
Amen to that. He's Dan Alpert. I'm Keith McCullough. You can find us both on Twitter. Thanks for joining us.